here are the ways in which you will end up paying a bookkeeper a lot. Even if you're a startup, it's best to start best practices of keeping your business and your personal finances separately. So you don't want to commingle personal and business in the same checking account. It's also advisable not to do it on the same credit card. For example, one of my experiences, we had somebody who was doing some shopping for the business. He used his personal credit card. He was the founder, and he went to like Office Depot and he bought a printer for the company, but then he picked up some other things that his wife asked him to get. And before you know it, he's like giving me all of his personal receipts, and I have to line item which ones are for the business and which ones are for his groceries. And so that's not, a lot of people, depending on what your personal buying habits are, you might not want everybody to know what you're buying personally. So you don't want that to be a business record, so you want to keep it on a separate card. Also important to note that there are a lot of great tools coming out now, thanks very much to our own Bay Area companies, that will reduce a lot of costs and make it easier to keep records. So Bill.com is very good for paying bills, and it syncs up with QuickBooks Online. It's also very good for managing receivables, like you invoice people and it keeps track of who's outstanding. Expensify is very good for having people file expense reports. It's best to have, it's easy to sort of say, hey, we're doing a startup, we're bootstrapping, everybody's just buying stuff when they need it at the store. But if you want to be reimbursed for that, and more importantly, if you want the tax deduction for that, you're going to need records, and Expensify makes it easier to record those things. We also recommend, again, business-only credit and debit cards. If you're going to choose a bank, it's good to choose a bank that links to QuickBooks Online or Xero. These are the two companies that we see most people using for their accounting software. It used to be QuickBooks was like this desktop thing, and they made you like upgrade all the time, and it was a real hassle. Then they moved online, but the online tool stunk. So then this other startup from actually, I think it's Australia or New Zealand, Xero, started taking a bunch of share, and now QuickBooks has like launched a refresh, and so now it's like sort of a two-horse race. But those are the two that we usually recommend. And the last thing I want to point out is keep your receipts. The IRS requires anytime you spend over $75, you have to have a receipt to demonstrate what that is. It's also important to remember, even if you have something less than $75, it's a good habit to keep a receipt, because let's say you travel and you park somewhere and you pay like $15 for parking. You might, if you don't keep the receipt, you might forget it. You might forget what it was for. And so that's receipts. Now you might say, well, look, I use my credit card statement. Oh, by the way, electronic receipts are great. I like email, like buying things online, because they email me the receipt. So even if I'm too busy to deal with it now, if it comes to tax time, I can go back and say, what was that charge? Oh, that's what it was for. So email is really great because you don't have to handle any paper. But at the very least, even if you're not going to file them monthly, just throw receipts in a sheet. Just have a box in the office and people just throw receipts in it. So later on, when you're being cheap and you're not hiring me, I can at least come in and have something to work with. Credit cards, a lot of people will say, I don't need a receipt because I put it on my credit card. This is actually kind of an ambiguous area from the IRS's perspective. According to the IRS, you are supposed to have, I don't remember the exact wording, but you need a documentation for what the charge entails. And so you might say, well, it was a hotel and I know I was traveling, so clearly that's room and board. But it's important to remember, you can also put food and beverages on your hotel bill. Food and beverage is only half deductible. The IRS only lets you, meals and entertainment, you only get 50% of a deduction for, whereas rooms, you get 100% deductibility for, and if you put them all on one receipt and just trust your credit card, it actually won't break those out. So you could theoretically be in trouble. Receipts are still better than credit card statements. If you have nothing else, credit card statements are good to back up, but if you're being responsible and moving forward, I'd recommend receipts. Let's see, what's the last point I had here? Oh, also, another thing you can do, thanks to recent technology, is you can actually photograph the receipt so you don't have to carry it around in your bag or your wallet and bring it back to the office and fill out an expense report and staple it to them like the old days. You can use Evernote, Dropbox, Google Docs, or probably one of your own where you take a picture with your phone, and as long as you get sort of good enough photo fidelity, you can save it to your Dropbox in a receipt file. I personally like Google Docs because Google Docs has a neat feature where I can take like 3 pictures and save it as one receipt. So if it's like, you go to Best Buy and they give you like a receipt that's 3 feet long, you can sort of take multiple pictures in the same file. You don't have to take 3 different file pictures. but that is something I strongly recommend, especially if your employees are complaining about receipts and expense reports. This kind of removes some of their excuse. More operational financing, as I already stated, here's a little bit about taxes. Meals and entertainment are only 50% deductible, so you have to separate them out from your other charges. Meals are especially a gray area when it talks about employee lunches. This is something the IRS has been kind of getting a little bit more particular about. Historically, Google would just say, well, we give away free meals, free lunch to all employees, and so that's a tax deduction at 50%. And it's like, well, technically speaking, to be deductible, meals and entertainment should have a business purpose. Specifically, for example, meeting with someone over lunch, it is absolutely deductible. It's only 50%, but it's unambiguously meets that deductibility requirement. If I'm out of town and I go to a restaurant and my company isn't going to reimburse me and I spend $20 for a meal, unless I have someone in that company, unless I have a business partner with me, another employee, and we're talking business, the rule is business has to be discussed for meals and entertainment to qualify. So that example would not. So what about someone working at their desk who orders out and the company allows them to reimburse it? Can the company reimburses them for it? Can the company charge that to the IRS? Can Google put all of their free food for employees as deductible? Because a lot of those might not have a business, there might not be a business meeting, business might not be discussed during that time. People might just be watching YouTube videos. That's a point of ambiguity, depends on who you ask right now. There's actually some articles that came out last year about that. So something to bear in mind. Employee payments in particular can be very tricky. This is like how employees charge things for business purposes. One option you have is to have them get their own cards and then you reimburse them when they file an expense report. The good news is it forces them to file an expense report. The downside is you have to reimburse them quickly because they're essentially they're helping finance the company, if you want to look at it that way. And also, not every new employee has access to good credit cards. After the financial crisis, a lot of people lost their credit ratings. They were always using debit cards, so they're actually not able to get credit. And so if they needed to buy something expensive, you'd have to share cards. Generally, if you're really small, we recommend having like maybe just one business card and everybody charges to the same card. The opposite extreme is you give everybody their own company card. So it's all the company's liability. They're not using any of their own credit, so that's the advantage of it. The disadvantage is people can go crazy and you end up with like $4,000 credit card bills and you're like, what the hell did you spend this for? It wasn't authorized. Also, one of the things we recommend is, have the CEO has a card and that way you centralize it, and the advantage of that is there's one person who's deciding on all purchase decisions, but the downside is you've got coordination problems. What if I'm out of town and I need something really quick? I got to buy a printer to print something out for whatever reason, and I don't have the CEO, and he's a different time zone, she's a different time zone, so it's the coordination problem. And also, oftentimes, CEO doesn't necessarily want to be responsible for everything. And then the last sort of middle ground is you have department or centralized cards. That kind of splits the difference. The important thing is if you have a department card, oftentimes everybody ends up getting access to the card numbers. I had to order something online, and it's oftentimes well-intentioned. Like I had to order something, so they gave me the number, but I didn't delete the number, and now I need something else, so I'll just use the same number and deal with it later, and then you end up with a surprise bill because it wasn't pre-authorized. So there's a lot of complications there, and there's different ways of doing it, each with its own advantage and disadvantage.